Hi again, everyone. I hope you're all doing really well. This video is a bit more of a rant on the current situation regarding the problems emerging due to central banks lifting interest rates and the banks passing on the rates seemingly without any thought for the ramifications on their customers. What I'm discussing is more aligned with the Australian property market, but I think it is applicable to many similar economies, i.e. the US, Canada, and many countries in Europe, which are going through pretty much the same thing. Now, I'm not speaking from my own position, but I think if banks, as they pretty much always have, continue raising rates like they have, i.e. mirroring the movements of the central banks, such as the Federal Reserve in America or the Reserve Bank of Australia, aka the RBA, it's going to lead to something quite dire. To have seen the property market pump up as crazy as it has over the past 18 months, and the fact that several lending restrictions have been lifted in Australia by APRA, which has allowed greater degree of lending risk to creep into the market, we are surely staring at a situation that is, at least to some extent, resembling the housing market crash that preceded the GFC. In the past 60 or so days, there have been 3 Reserve Bank meetings, and commercial banks have now made their average customers about $450 per month poorer in this time, based on lifting borrowing rates by 1.25% and based on a $600,000 mortgage. I know obviously this is a little bit higher in the USA, but it is still quite significant. If the cash rate realises the predicted rates for this year alone of 2.5% and banks continue to mimic these movements, average households in Australia will be about $900 per month poorer. And that is a very significant dent in any household budget. When you factor in the well-publicised cost of living, particularly around fuel and energy prices, meeting basic living conditions of food, shelter will be very challenging in the future. What is even scary is that a number of economists are predicting interest rates to go even higher than what are being forecast by central banks so far this year, and there's also predictions around energy costs continuing to soar. The effect of these rate rises is we are expecting to see a correction in property prices, which could mean we are possibly going to have a situation where people who have bought properties recently are going to be as much as $900 per month worse off or more, and many of these properties that they own will depreciate in value to the point where borrowers owe more than the property is actually worth, also known as being in a negative equity position. In Australia, many of the big banks, such as the Commonwealth Bank of Australia, Westpac, and NAB, champion that they are all about helping their customers and putting them first. But recently, you would really have to question that messaging, which was probably viewed as hollow at the best of times anyway. The fact that banks such as the CBA just the other week bumped up their fixed rate offerings by over 100 basis points without saying a word and have put out limited messaging around the swift changing to their variable interest rates increases does not give off an image that they care for their customers at all. However, they have always been very long-winded when justifying why they could not fully pass on rate cuts in the past. By having such a high fixed rate offering and continuing to soar variable rates, the customers that they care about so much are stuck between a rock and a hard place. I really have my doubts that there will come an RBA rate rise in the near future where any of the major banks come out and say, we won't be passing on this rate rise to our existing customers as we understand the mortgage distress it will place on them. The goal of raising the rates right now is to minimise spending and slow the rate of inflation. Existing bank customers have already had their spending capacity capped by about $450 per month. Why not just limit rate rises to new business and apply them minimally to existing loans in order to protect the valued customers? I know the textbook answer to such a question would include the likes of staying competitive in the market and the cost of finance, etc. By raising rates like this, banks are going to leave many of their customers destitute. Anecdotally, people with mortgages are often quite conservative with their spending, especially in the early days as they try to budget to meet the mortgage obligations. These aren't the people that are driving up inflation. Many of the inflation issues are linked to the supply chain issues that have been lingering since COVID, and the fact that governments just printed and handed out money to everyone and then encouraged them to go and spend it. Instead of punishing the population with monetary policy, why can't governments use fiscal policy to improve and ease supply issues? It's like conducting a bombing raid to cut down a tree. A lot of this doesn't make much sense, and the general population is experiencing a severe erosion in its living standards due to these decisions. Anyway, that's where I'll leave it for this rant. This has been an issue that has been frustrating to observe over the past few weeks and months as it has unfolded. On another, I'm sorry I haven't posted on my channel regularly lately. I've been on full-time daddy duty, and that has preoccupied much of my time, and I haven't been able to put in the same sort of effort towards making videos. Hopefully I'm able to get back to a bit more of a regular routine and habit with that going forward. If you like this format of video where it's like a lower production, let me know your thoughts in the comments below. Until next time, everyone, may the markets trade in your favor. Cheers.